If commercial real estate pricing feels different right now, you're not imagining it. So, whether you're buying, selling, leasing, or you're just trying to understand what property is worth, the numbers feel different than they did a few years ago. And it's not because of just one thing. It's not just the interest rates or inflation or COVID era impacts on the industry. It is actually a combination of all those things happening close together. So, COVID changed how businesses actually use their space. The low interest rates helped to push property values higher. And then we had a rate increase. The construction costs went up, insurance costs skyrocketed, and lenders became a lot more cautious. Then tenants started to look at their space differently. So today, pricing feels different, but the truth is, the market is always changing. To understand today's pricing, you really have to start with COVID. Before COVID, a lot of businesses had a more predictable relationship with their space. Office users needed office space. Retailers were focused on storefront traffic. Industrial users needed warehouse and logistics space, but demand had not yet accelerated the way it did during and after the pandemic. Then, COVID disrupted all industries. Some office users moved to remote or hybrid work. Some retailers had to rethink how customers buy. Industrial demand grew as companies focused more on storage, distribution, and supply chain flexibility. At the same time, interest rates were extremely low. Money was cheaper, and buyers could borrow more affordably, and investors were often willing to pay aggressive pricing for commercial spaces. That created a very different pricing environment than the one we are in right now. The biggest shift today is that the math has changed. Commercial real estate is heavily tied to financing. Most buyers are not buying properties entirely in cash. They're actually utilizing debt. So when interest rates are lower, buyers can typically afford to pay higher amounts because their monthly debt services are lower. But when interest rates increase, that same property may not support the same purchase price. This is why a seller may look at a property and say, this should be worth what it was a few years ago. In fact, I just had that conversation yesterday with a client. But a buyer is looking at the same property and saying, what can this property actually support today? Those are two very different questions. Here's a simple example. Let's say a commercial property produces $100,000 a year in net operating income. If buyers are valuing that income at a 6% cap rate, that property would be worth $1.67 million. But if the market now requires an 8% cap rate, that same $100,000 in income supports a value of $1.25 million. The building did not change, the income did not change, but the required return changed, and that changes the value. That is one of the reasons pricing feels so different right now. A property can still be a good property, but it may not support the same price it did in a lower rate environment. And this is where leasing becomes a major part of the conversation. So commercial real estate pricing is not just about the building itself, it's about the income the building produces. A property with strong leases, quality tenants, rent increases included, and several years left on a lease term is easier to value. Whereas a property with vacancy, short-term leases, below market rents, or tenants who may not renew is harder to value. The uncertainty affects the pricing. So when people ask why commercial real estate pricing feels different, part of the answer is that leasing feels different too. Tenants are more careful now. They are not just asking what is the rent, they are actually asking what is the total cost of being in this space. That's going to include things like rent, operating expenses, their maintenance responsibilities, and build-out costs. A cheaper space may not be cheaper if it needs major improvements or does not function well. And a more expensive space may actually be better deal if it is move-in ready, better located, or saves the tenant time and money getting open. That is why lease pricing is not always as simple as comparing one rate to another. The structure of the lease matters, the condition of the space matters, tenant improvement costs matter, and the length of the lease matters. Here is another simple example. So imagine two small warehouse properties. You have property A, it's fully leased with a stable tenant on a 5-year lease term with annual rental rates built in to increase. Whereas property B is vacant, it needs some office updates, the building has deferred maintenance issues, and the owner is assuming it can lease at top market rental rates. So from the outside, these two properties may look very similar, but to a buyer, they're very different. Property A has income and property B needs capital injection. That doesn't mean B is bad. It may still be a good opportunity, but the buyer is going to price in what it's going to cost as far as time, their actual capital, and risk of getting that building leased. That's why leasing and property value are so closely connected. This is also why landlords and tenants may feel like they are looking at the market differently. Landlords are dealing with higher costs too. Their insurance, taxes, cost of repairs, financing, and construction costs have all increased in many cases. So even when a tenant expects a lower lease rate, the landlord may not have as much room as the tenant thinks. At the same time, tenants are also watching their costs closely. They may be dealing with higher labor costs, equipment costs, increased inventory costs, or their financing expenses. So lease negotiations have become more about finding the right structure. Maybe the rent stays firm, but the landlord offers some free rent. Maybe the tenant signs a longer lease in exchange for improvements. Perhaps the landlord helps with move-in timing, or maybe even that the tenant chooses a space with a higher rent because it avoids large build-out cost. In today's market, the best deal is not always the lowest rent or the highest rent. It is the deal that actually works for their business. So what's the main takeaway? Commercial real estate pricing feels different right now because the market is always changing. COVID changed how businesses utilize space, while low interest rates push pricing higher, and those higher rates change what buyers can afford, and operating expenses increased. Leasing demand became more selective, and all parties in a transaction are trying to adjust. That's why old comps don't always tell the entire story. A sale from a few years ago may have happened in a completely different financing environment. So a lease comp from before COVID may not reflect how tenants evaluate space today. And a broad market headline may not apply to your specific property, tenant, or location. At the end of the day, commercial real estate pricing comes down to three things: income produced, risk, and cost. What income does this property actually produce and bring in? How reliable is that income? And what will it cost to finance, maintain, or improve the property? If you're trying to understand what a property may be worth, what a lease rate makes sense, and how today's market affects your next move, reach out to Right Space Commercial. We would be happy to look at your current numbers and compare your options and understand what's really driving the value in today's market.